Sure, it's too big. It's okay. Ta-da! Hi, Christine.
Yeah, hello, how are you?
Okay, so you ready for your
My dog.
next pass through chapters 1 and 2 again, huh?
Sure.
That's
Yep.
good. That's good. All right, we'll wait a few minutes to see who shows up. Jeremy, how you doing?
I'm good, and yourself?
Good. Welcome back. Welcome back.
Thank you.
Is that Natasha? Hi, Natasha. Natasha is muted. Hi, Lauren.
Hello.
Hey, Lauren's there. And
Natasha is.
oh, is that Natasha?
I figured it out.
There you
Hi,
go.
everybody.
All right. That's the first lesson we got.
Woo! I know,
Lauren?
it's the hardest part.
Excellent. Hi, Shannon. Shannon is muted. Oh, there's Shannon. Good to see you.
Hi.
Good to see you. And Lauren is here. Hey, Lauren, do you want to show your face, or are you going to hide out on us? It's up to you. Well, we'll see what Lauren decides to do here. Okay, Patty's here. Hey, okay, Lauren says she has to remain incognito, which is okay. And then we have Patty, the man from the Welsh background, which I enjoyed hearing the other day, huh? Okay. It's about 12. We'll wait another minute and see what happens. Anybody having problem with the homework yet? I wouldn't think so right now, but at this stage. Tutoring, a couple of you came for tutoring yesterday, which was very nice. And we went through a quick chapter 2 review. So I guess we're ready to start. What we're going to do today is go through chapter 1. Even though I went over it in the first class, because this is when we were really scheduled to do it. And we're going to go over it again in a shorter form, and then we'll go into chapter 2 and see what goes on from there. Okay. Hi, Bastian. Bastian is connecting to audio. Okay. So why don't we get started? Hi, Bastian. Can you hear me?
Yes. Hello?
Yeah. Am I saying that name correctly?
Yes. Hey, everybody. I just don't have a camera at the moment, so.
Okay. You're not related to Red and Lou Bastian, are you?
Nope.
In my youth, as a child, I loved professional wrestling. And the Bastien brothers, what a couple of dirty guys they were, boy. They were downright vicious, those guys. Now, hold on here. Come on, what is this thing doing to me? Okay, here we go. We can all see the screen now, right?
Yes.
It says Introduction to Accounting. Okay, we're going to go through chapter 1 kind of briefly. It's just a brief introduction about different types of businesses and who reads this information. And then chapter 2, we get into a little bit of nuts and bolts before we hit things hard with chapters 3, 4, 5, and 6. If you guys survive chapters 1 through 6 and you feel, actually chapters 1 to 5, I think, you go through 1 to 5 and you're comfortable with the material, you're ready for 230. Everything above that is gravy in this class. So let's get off to a good start. The purpose of accounting, it's the language of business, huh? You can tell people you have a wonderful business and the business is growing, but you better be able to put numbers to it, huh? It provides current information about the operations, and it gives information to various people, agencies, organizations. Who uses accounting information? Now, this is the problem that Cornelia had us do together in Monday, where we had the owners, managers, creditors, government agencies. And we start with the owners. The owners certainly want to know if the business is making money. They want to know the condition of the company, meaning their accounting equation. They want to make sure that they have sufficient assets and capital. And if a business is good and they know it's good based on the numbers, maybe they can invest in another factory, another store, or they may need to calm down and eliminate people or processes. Managers, when we're talking managers here, to me, we're talking about the sales manager, perhaps, of a big company. His bonus may be contingent on how many sales he makes. Okay. The managers, production managers may get a bonus on how few scrap items they make. Okay. Creditors, creditor is a lender. A creditor is a lender. So no one is going to loan this company money or any other company money unless they know reasonably well that you can pay your bills back. So how are they going to do that? They're going to talk to you, get a sense of what kind of person you are. They may visit your business, actually, look around a little bit if it's a big deal. They're going to ask for your banking information. And guess what? The financial statements. Okay. Creditors, they will not loan you money unless you can prove you're going to pay them back. The lenders are funny that way, right? Government agencies, we're talking taxes. Government agencies, they want to make sure that the cash flows and the condition are okay and that you're able to pay your taxes. Now, the other day, one of the students answered that the detailed measures of business performance, the student said that's the owners, and it marked it wrong. Well, that's not really wrong, though. The owners are certainly interested in the details as well. They want to know how a particular product line is doing. They want to know some recent trends and what's been happening. Okay. Describe the accounting process. We're gathering information to provide statements to the users. Now, just take a deep breath and look at this page here, because this page is usually the source of a couple of multiple choice questions on the test. The accounting process. You analyze something, you record something, you classify, you summarize, you report and interpret. And supposedly they're done in that order, which is pretty correct. Analyzing, I keep saying it can be anything from, well, here's the payroll printout from this month. And you look at the payroll and you say, wait a minute here, our normal payroll is about $1 million a month. I'm looking at a $2 million payroll here. What happened? And then you say, oh, so-and-so made a mistake. We accidentally started to pay her $100 an hour instead of $10 an hour. That type of analysis. You get the electric bill in the mail. You look at it. It looks reasonable. Well, now you're ready to record a transaction. That's what we're recording, transactions. You're going to go into your system and you're going to tell QuickBooks or you're going to tell Mass 90 or whatever system you have that our electric expense or telephone expense went up and our cash went down because we just paid it. And then you're going to classify it into your financial statements in terms of, is it an expense? Is it an asset, which we'll get to? You summarize these things for people to understand. You report them, and you report them via your financial statements. You tell the results, use tables and numbers, and interpret. Not a lot of emphasis on this particular page. It's just that since we're stuck in this online Zoom world, we're taking the questions directly from random from the test bank, and they threw a few of these out. Know these two terms, huh? GAAP, generally accepted accounting principles. GAAP, generally accepted accounting principles. These are the rules promulgated by FASB, the Financial Accounting Standards Board. So let's have these in our minds as we begin going through accounting and understand what we're talking about. Generally accepted accounting principles. These are the rules companies must follow when they're preparing their financial statements. Okay. Gotta get myself centered a little more here. can't, can't get myself in the picture. Okay. Generally accepted accounting principles. These are the rules that companies follow. They guide everything from when do you record an expense? When do you record a revenue? Is this the proper way to do something? GAAP, generally accepted accounting principles. The Financial Accounting Standards Board, that's the unit of the American Institute of Certified Public Accountants. And what they do is what you see here. They identify an issue. And I'm going to take you through my favorite issue because this one's fairly recent. We've all probably gotten or used gift cards at one time to Chipotle's perhaps, or Costco, or Target, or Macy's. Well, the person who bought that card handed Macy's $100. When Macy's got that money, they could not call that income. They could not say they made a profit of $100 at that point. In fact, it meant that it was a liability to Macy's. Macy's owed that person $100 worth of perfume or something. And what would happen over time is many people never use those cards. They kind of get put in a drawer and forgotten. And this didn't seem right in the world of accounting for years. So the FASB decided that if you are a business and you're in the business of taking gift cards, you now have to estimate how much of that you're not going to retrieve in terms of sales and record it on that basis. So that's an example of identifying an issue, and then they discuss it, and they hold public hearings and exposure driven. It's a lot complicated. And the reason it's complicated is that GAAP and FASB are also subsidiaries, if you will, of the Securities and Exchange Commission, the New York Stock Exchange. No company can put financial statements on, no company rather can list themselves on a stock exchange without audited GAAP statements, okay? So let's try what we have next here. Okay, this is simple. No, I don't want to say simple. When I use the word simple, you should tell me not to say that because that's not the case for everybody, right? 3 kinds of ownerships: sole proprietorship, partnership, corporation. Well, we know what a sole proprietorship is, I think. That's one person opens up a small business typically, huh? You know, it could be something as simply as a lunch truck that somebody runs. That's their business. It can be something as complicated as a lawyer, could be a sole proprietorship, a store owner. Sole proprietorship, partnerships, 2 or more people, right? 2 or more people, they share responsibilities, perhaps not equally. It depends on the partnership covenant. And a corporation, you and me, we are the people who own corporations when we buy shares of their stock. I own 100 shares of Coca-Cola. That makes me an owner of Coca-Cola. I am an owner of Coca-Cola. You ever go to the beach and pick up a grain of sand? The beach is Coca-Cola and that grain of sand is my ownership. But I have the right to vote. I have the right to go to their meetings and yell at management if I deem it necessary. Sole proprietorship. Let's understand the most important thing here. You open up a business as a sole proprietor, you're assuming all the risks, which is a negative. But the positive is you make all the decisions. You decide how much you're going to pay yourself. You decide if you're going to hire employees. And when that says it says their owners assume all risk, it's a personal risk too. If you open a business with, say, $10,000 and the business goes horribly wrong, and at the end of the first year, say, you're at a business and you owe $100,000 to people, you just can't say, well, here's the 10,000. That's all I put in the business. No, you're fully responsible for that 100,000. And they can come and they can take your car and, garnish your paycheck if you're working again. So there's that risk of personal liability. And that liability exists with a normal partnership. Now, there's different kinds of partnerships, which you'll learn in other classes. But the partners share risks. If the partnership goes bankrupt, each partner has to go into their own personal bank account and make good. And one of the disadvantages are partners may disagree on how to run the business. And that's been the plot of many murder mysteries on television. Uh-oh, the partner was shot. Where's the other partner? Got to find him. Corporation. Now here we go. Owned by stockholders. Who are the stockholders? We are, the public. We go out and we buy shares of Coca-Cola. We have that. If Coca-Cola goes bankrupt and owes billions of dollars, we don't own anybody anything. There's no personal liability, no personal. And then briefly, we'll go over different types of businesses: service business, merchandising, manufacturing. Another way to say it is accounting 110, accounting 230, and accounting 240. For much of this book, this course, we're going to be a service business. We're going to be somebody who delivers something. We're like a delivery service. I think it was a student opened up a business delivering pizzas. So that's what we're going to be doing. There's no product involved. We're not buying or selling anything. We're providing a service. Merchandising is you buy and sell something. Merchandise means inventory. Merchandise would be like Nordstrom's. It would be a store for the most part. And we will get into that in this course later on. Manufacturing businesses, they make a product. That's where I worked my entire working career until about 20 years ago. I was always working in factories. You work for Coca-Cola and you see this bottle here. Your job is to figure out how much this plastic cost, how long it took the person to fill the bottle. It can be very dreary at times, but interesting overall. What's a service business? A travel agency, computer consultant, a physician, a lawyer. Merchandise business. I see two words there: stores. Merchandise businesses are stores. Manufacturing, people who make a product. Automotive manufacturer, that would be Ford or Chevrolet or Honda, right? Furniture maker, IKEA, IKEA. And toy factory, maybe Mattel or Hasbro or somebody. And we'll end up with this business about career opportunities in accounting. I'll go through this kind of quick. Accounting clerks. This is a job where you don't really need any real training. What you need, though, is the ability to think a little bit and learn. And you go in there and you might be in charge of one little area of the company in terms of accounts receivable or accounts payable, say. The accounts receivable clerk would collect the money and enter it into your computer system. Accounts payable would do something similar. Accounting clerks. Bookkeepers, well, that's why some of you have already mentioned to me you're going for your bookkeeper certificate, which is a great thing to get. You put that on your resume. You have an employer now who knows that you went through 2 pretty good years of school here, and he assumes that you have a basis of knowledge, which you will do if you get through here, and it pays more. I never heard of a para accountant. And then the accountants, these are the guys, men and women with the 4-year degree. They're going to be doing more than just crunching numbers. They're going to be designing systems, a lot of analyzing. What are we going to do in the future? Different accounting careers. Public, you work for an accounting public CPA firm. Public accounting means a CPA firm. You're going to come into private companies and analyze their statements and bless them. Private accounting, that's anybody who works other than a CPA or for the government. You work for a factory. You work for a store somewhere. You work for a manufacturer. And then public accounting, they do auditing, taxation, and they added a few things here. They've added management advisory services, which can really, really lead to trouble. That can really lead to conflicts of interest. Has anybody ever heard of Enron, the crash of Enron Corporation? Well, I like to talk about that. I'm not going to do it now. But that was a company that really failed because of these conflicts of interest. And you can become a CPA, certified public accountant. Hey, I passed the test back in the 1970s sometime, huh? Certified fraud examiner. That's a good one. Certified fraud examiner. You can change fraud to forensics. You ever watch the Forensics File on television, those silly crime shows I like to glance at once in a while? A lot of them as well. We brought in an accountant and we looked here and we found out that Simmons was the murderer because he was stealing. Private accounting, controller, that not too much here. These are just higher levels of the accounting world. Governmental nonprofit. I worked for a nonprofit when I came up here. I was the Chief Financial Officer of the clinics. If you know anybody familiar with the Santa Barbara neighborhood clinics in town, I was there for about 4 or 5 years. And here they're just talking about different opportunities. Accounting clerk, they're saying a good accounting clerk can make $38,000. They're just giving you some examples. I don't know how true these numbers are. They may be a bit on the optimistic side, but you get the point. Bookkeepers make more, 41,000. Budget analyst. I used to love doing the budgets at the factory. That was a big, complicated job. And once you do it for a while, it becomes second nature and you can really put some nice budgets together. Accounts payable manager. Well, they're saying here an accounts payable manager could make as much as 83,000. Well, that seems like a lot for someone who's just basically doing a small part of the business. But a good accounts payable manager can save a company millions, millions. I would pay more than that for a real good AP manager. Same thing with auditors. They make good money. Auditors, controller. Anybody yes, I was a controller. That's what I did my whole world until I became the CEO of the, not CEO, the Chief Financial Officer of the clinics up here. Controller. That's the end of chapter 1. Does anybody have any questions before we go into chapter 2? Going once, going twice. Okay, let's get into chapter 2. Do we all see the screen now saying chapter 2? Can somebody nod or wave at me that you can see it? All right. Natasha sees it. That's good enough for me. Got to do my Sheldon Cooper thing here. I got to set this up my way. Oh, for heaven's sake, what happened to my cursor? Who stole my cursor? Oh, there it is. It was hidden. Slideshow. Ah, does not look much better. The accounting equation. Let's come out of this chapter understanding the accounting equation. Let's never forget the accounting equation and how you manipulate it with transactions. We're going to do some transactions, okay? So let's take a peek here. The accounting elements, huh? The accounting elements. An organization that, in business entity rather, an organization that engages in economic activities and controls resources. That's a bunch of baloney for a business, a store, a factory, okay? Somebody's trying to make a profit by providing service or goods to the public at a profit. And the second bullet here is more important. The owner's personal finances are kept separate from the business. Now, that might sound obvious, but since we're working with small companies here, we're going to get into a situation where the owner comes out and says to the accounting guy, cut me a check now for $500, please. And that requires special handling, okay? Business entity concept. This simply means that a business has assets and liabilities that are strictly the business's and does not include personal items. If the owner invests money now, well, that's a business asset. These last few slides, not too terribly helpful or useful to you in terms of the chapter. But when you're writing up your summaries, be clear, what's an asset? An asset. This is the start of our accounting equation, assets. What's an asset? It's something that is good to own, something of value owned by the business, something that is of value, something that is of value that will provide future benefits. Well, it's nice to have cash, but we want to turn that cash into more cash. Maybe we're going to open up another store or something. Merchandise means inventory. Merchandise means inventory. Inventory is the cost of the goods you're selling. Merchandise, we bought a garment for $500. That's our inventory or merchandise. We sold it for $2,000. Well, that's our profit, $2,000 minus that $500. Other assets, obviously buildings and furniture and things. Let's talk about the last one though, accounts receivable. Let's get conversant with accounts receivable. Accounts receivable, you look at your balance sheet And whatever the number is there for accounts receivable, that represents how much your customers owe you at that exact point in time. Accounts receivable. It results from making sales on credit. And the whole world works on credit, right? I mean, when Bill Gates delivers 1,000 computers to a big school, the truck driver doesn't sit there and say you can't have the computers until you fill up the truck with cash. That would be silly and inefficient. So everything's done on credit. Customers have promised to pay sometime in the future. So when you sell something on credit, there's no cash. When you see the words on account, it means on account of no money. On account of no money. What I mean by that, there's no cash involved in the transaction at the point of sale. Accounts receivable. Well, assets are good things to own. They're offset though, huh, by liabilities. A liability is a debt. A liability, let me just let this guy go by here real quick. I live in an apartment complex up on the mesa, and that garbage guy amazes me how fast he can back that truck up this narrow turn here. He makes it every time. Okay, liabilities. These are debts. These are IOUs. These are accounts payable, which is the opposite of accounts receivable. It's an obligation of the business that can be paid off with cash, huh? Accounts payable, notes payable. They're two different things. I'm not going to go into that in detail just yet. Okay, we talked about accounts receivable. If you have $1 million in accounts receivable and you're my customer base, we're somebody's customer base, it means that I owe 100,000, Christine might owe $250,000, Jeremy, he owes us only a few hundred. You get the idea. It's accounts receivable represents the number of the total dollars owed to you. Accounts payable is the opposite. It's what you owe to others. And I got another little glitch here. Sorry, guys. I got to move. My battery's wearing out. My battery's wearing out. And so apparently is the computers. Okay. May not be able to see me as clearly, but I can't do much about that here. Accounts payable. Don't confuse accounts receivable and accounts payable, which is easy to do. You are going to, let me see if I can make myself seen here real quick. And it helped. Oh, Jesus, that's even worse. Okay. Accounts receivable, accounts payable. Accounts receivable, money owed to you. Payables, what you owe. It's the same transaction though, right? The seller calls it accounts receivable. The buyer calls it accounts payable. Note payable is another liability, but it's not accounts payable. Accounts payable represents the people you normally do business with, your vendors and suppliers. Notes payable, you borrowed money and there's interest to pay and there's a written contract and severe penalties for not paying. Assets equal liabilities plus owner's equity. That's your accounting equation. You have a company that has $1 million worth of assets and it has $200,000 worth of liability. That means that the owner's equity, which is also called the net worth or the capital, is $800,000. Assets equal liabilities plus equity. Also be called net worth, capital, could be called stockholders' capital, different terms for it, okay? Let's look at the accounting equation. There it is. You're seeing it for the first time, huh? Assets equal liabilities plus equity, huh? You know, I have a company that has $50 million worth of assets. If I went up to say, I don't know, Natasha, say, Natasha, I have a company here. I got $50 million worth of assets. I'll sell it to you for $100. Would you do that? you would probably suspect something's wrong, and you would be right, because I may have 50 million in assets, but I also have 60 million in liabilities. And the company's basically out of business. It's insolvent. So assets equal liabilities plus owner's equity. That is what we need to really learn in this chapter here as we go forward. So they're just giving you a brief example. Business has total assets of 6,400, liabilities of 54. What's the owner's equity? It's going to be the difference between the two. 6,400 minus 5,400 is 55,000. And you see that note? The accounting equation must always remain in balance, huh? Who knew? It always remains in balance, huh? I feel like I'm in the witness protection program here, seeing my dark face, like I'm on 60 Minutes or something. Analyze business transactions. Okay, here we go. Here's what we're going to do for the rest of the chapter. We're going to look at some business transactions and record them in simple plus minus increase decrease language. Business transactions, any economic event that affects the business, could be a lot of things. You got bills in the mail, those require transactions. You paid out some bonuses to employees, that's a transaction. You bought something, all kinds of transactions, and you're going to record these with the accounting equation in mind, okay? What's an account? Well, you're going to see something in your book. I think it's I believe it's in the inside cover of your book. For those of you who have the hardcover, you're going to see something called the chart of accounts. And each account, think of it as a separate folder, a separate drawer in a big desk, huh? And that's where you're going to isolate different charges. Remember we talked about classifying? That's what we're talking about, classifying to a particular account. So when a transaction occurs, what happened? Make sure you understand what's going on, what has taken place. I go back to my favorite easy transaction. You got the phone bill in the mail. What happened? We got the phone bill in the mail. What is affected by that? Well, we have a phone bill here, so we have to identify the accounts. Well, this company probably set up an account, a folder, if you will, for telephone expense. So we know that that expense is going to go up. It's going to go up. And that our cash is going to go down if we choose to pay it. So let's take a look here. We classify and we have to determine if the accounts went up or down, okay? Always keeping in mind the equation is going to remain in balance, okay? Show the effects of business transactions on the accounting equation. Analyze the effect of them. Are you ready? Here we go. We're going to do some transactions. Mitch Williams, the owner, invested $5,000 in his business, okay? So he took $5,000 from his own bank account and he put it into a new bank account. He called it the Mitchell Williams Company or something. So that's a transaction. What happened? Cash went up, right? He put cash into the business. There are no liabilities here. So you know it's capital. You know that Mitch Williams now has a business that is worth $5,000. So going through their thought process, cash is an asset, capital, that's owner's equity, cash went up, equity went up. Ta-da! Your first look at the accounting equation as we get started. Assets equal liabilities plus equity, 5,000 equals 5,000. So let's continue. What happened next? Our second transaction. Mitch bought delivery equipment and he bought it for cash. So what are the accounts that we're going to worry about? Cash. A company certainly has a folder just to keep track of cash. And they're also going to have an account probably for delivery equipment. So they're both assets. How about that? They're both assets. So one asset went up, one asset went down. Let's take a look at it. What went up? The equipment. We didn't have any equipment. He went out and he bought equipment. He bought scooters or something. He bought scooters or something, and he paid for it in cash. So the total assets remained $5,000 and still were in balance. Now he bought delivery equipment on account of he didn't have any money. So when you see on account, you're going to pay it later. It's either going to be accounts payable or accounts receivable. When you see on account, it's going to be either accounts receivable or accounts payable. Well, this is clearly accounts payable. So let's see what happened here. The equipment went up. The asset went up by 1,800, and so did the liabilities. He now owes that money. So taking the next look at our growing accounting equation. He bought more equipment for 1,800. So now he has $3,800 in equipment. The assets have grown to 68. Oh, I'm so sorry, guys. Bad touch with this thing. The owners in equity stayed the same. The difference is the 1,800. We're in balance, okay? Any of you have questions or any comments? I'm going too fast. Let me know. I tend to get that New Jersey voice thing going, like Joe Pesci, and get a little too fast. Now we're paying a loan, right? They're calling it a loan. It wasn't really a loan, but that's okay. We owe $1,800. Well, it's now later in the month. Now we're going to pay $600. 600. So what's going to happen here? What happened? Well, we're paying down a bill. Well, the debt has to go down, the liability goes down, but so does cash. So does cash. So let's take a look here. Accounts payable goes down by 600 and cash goes down. Notice equity's not affected here, not affected yet. So there you go. Prior to this transaction, these two numbers were 6,800, 6,800. Now we've reduced our assets and reduced the liabilities, the debt, the IOU. Now we get into something new. Revenues, the amount of business charges customers for products sold or services performed. Revenues mean sales. Revenues mean sales for the most part. And those sales are recognized according to GAAP rules, generally accepted accounting principles. You record the sale when you make the sale. It has nothing to do with the cash movement, okay? Here, he charges revenues, or what you charge your customers, okay? If you deliver pizzas to a New Year's Eve party on December 31st, 2020, and you delivered $1,000 worth of pizza, that revenue goes into December, even though you're not going to get paid until the next month. So the cash does not necessarily follow the transaction revenues or expenses, huh? And what kind of revenues do we have? Well, with this business, he calls this revenues. He could call them all sales, but he says, well, let's see, I have delivery fees, consulting fees. I rent out part of my office to somebody else. I own some bonds that pay interest. So expenses are the opposite, huh? Expenses, rent expense, salaries expense. Expenses represent the decrease in assets or increase in liabilities as a result of efforts made to produce revenues. What? We know what an expense is. An expense is a necessary cost a business incurs if they want to stay in business. You have people to pay. You have people working for you. Salaries expense. You're gonna have to pay taxes, rent. This is what's called. They're not using this particular word here, but there's a word in GAAP for this concept. The concept that income determination can be made periodically. In other words, you can have a business, and the business is considered an accounting continuing entity, a going entity, means it's expected to last for a while. Well, what's going to happen is you're able to break that business down into a month, a quarter, a year, and split it up into those kinds of small bites and come up with the financial statements. Any accounting period of 12 months is called a fiscal year. A fiscal year doesn't mean necessarily January to December. It can be like General Mills, which comes out of the old farming companies of the 1800s. Their fiscal year begins with planting season, ends with harvest. Nordstrom's, their year end is like February 28th, because they want to scoop up every sale they can get into December and have a month or two to digest that. Net income versus net loss. Well, you don't have to go to college to know this, but let's take a look at it. Net income, the revenues are higher than the expenses. Net loss, the opposite, huh? Net income, sales or revenues were 9,000. The expenses were 5. This company made a profit of 4,000. Wow, that's pretty good. But this guy did terribly. His sales were 3,000. His expenses were 5. So he lost $2,000. That means at the end of the month, this company is worth $2,000 less than it was at the beginning. Now, here's something new. Withdrawals. Remember, we were talking about the personal assets of the ownership being separate. Withdrawals. The owner withdrawing cash from the business. It reduces the business equity and assets. Withdrawals, you can call them drawing as well. This is what I'm talking about. I'm the boss of this little company. And I go out there and I say, Shannon, give me a check, please, right now for $1,000. And Shannon's my accounting person, and she has to ask me what it's for. You got to know what, to understand the transaction. I say, yeah, boss, what's it for? And I say, I'm taking my wife to Las Vegas this weekend. Well, as soon as you hear that, you know it is not a business expense. It is a drawing. And thus, what it does, it reduces your cash and reduces equity. Okay? Drawing is not an expense. It is not an expense. It's the business owner deliberately reducing the value of his business by pulling money out. Okay? So here we go. We're now looking at our expanded accounting equation. Assets equal liabilities plus owner's equity. What affects owner's equity? Take a look at it. Well, Mitchell put 5,000 in, right? So that affected it. If Mitchell takes money out of the company, that'll be a drawing. If he sells something, that will increase the equity. And if he incurs an expense, it will decrease the equity. So let's continue here. Mitch received $2,100 in cash for delivering some pizzas. So what happened? He sold pizza for cash. Well, what accounts are affected? An asset called cash, that's going up, and his revenues are going up, and he calls this particular revenue delivery fees, huh? So as cash increased by 21, revenue by 2,100. Take a look at your expanded accounting equation. Revenue, 2,100. Cash went up 2,100. So now the business is worth $8,300 all of a sudden. It went from 62 to 83. He paid for his rent. Rent is an expense. Rent expense. The expense went up. And since he says they paid it, whenever you see paid, you know it's a cash transaction. Cash goes down and that expense goes up. So again, take a peek here. Expenses were 1,000. And notice off to the right where it says description, they're showing you what the individual expense was, okay? Otherwise, they don't want to show a column for every expense. This thing can go out forever. So what's happened here? Well, remember this business was worth $8,300 a moment ago. Now it's down to $7,300. Cash is down to $3,500. We're still in balance. The phone bill, the same thing. The phone bill, that's an expense. So that goes up and we're paying for it. So now we have a new expense, $100, and we took cash to pay for it. Looking at this company right now in the middle of the month, if this business closed today, if this business shut down at the end of the month to run statements, they would have a profit of, oh, I'm so sorry, guys. I'm so blundering with that keyboard. You notice the revenues are 2,100, expenses are 1,100. He has a profit right now of $1,100. That's all your net income is, revenue minus expenses. Wow, look at all this writing for a simple transaction. He delivered pizzas on account of there was no money involved in the transaction. So that's a good thing for Mitch, huh? $2,400. That's a sale. That's a sale. That's a revenue going up $2,400. He didn't get paid yet though, because it's on account. But what's the next thing, best thing to cash? Accounts receivable. Accounts receivable. So notice in the blue, we've added a new account. These are called accounts, folders. Accounts receivable is now up to $9,600. The revenue has grown to $4,500. And now this guy's looking at a profit of about $3,400. So important, this note. This note is real important. Make sure you have this in your summary, and then talk a little bit about it for a couple of sentences. You know, you could write a 50 pages summaries every month if you wanted to. Yeah, I sure would point in here. An important point is revenue is recognized when it's earned. Has nothing to do with when the cash is received. And you might make a point that that's proper GAAP accounting. Everything's on an accrual basis. We bought supplies for $80. Now this brings in a little bit of a complication. I'm going to work us through it briefly. He bought supplies for $80, but the supplies are going to last for several months. Because we're not using the supplies yet, we're buying an asset called supplies, okay? It's not supplies expense until you use the supplies. So now we've added another asset account called supplies. We bought supplies, $80, and we paid cash for it. We're still in balance, $9,600. Prepaid expenses. The supplies will be charged off to expenses when they're consumed, okay? Now here we go. Remember we sold some pizza for $1,900 and for $2,500, whatever it was? Now we're getting paid. Now we are getting paid. Our customer is paying us. Hooray. So cash is going to increase an asset, but another asset's going to decrease, and that is accounts receivable. Whenever you get money whenever you receive money for accounts receivable or pay accounts payable, there's no impact at all on revenues or expenses. Let's take a look here. Well, this guy owed us $2,400, and now he paid down $1,900. So one asset went down. We just swapped assets. One asset went down. One asset went up, huh? We purchased an asset making a partial payment. Good gosh, huh? Good gosh. Mitch bought a scooter for $1,000, paying $300 cash and agreeing to pay the rest over 4 months. All right, huh? Here we go. We have our first 3-account journal entry, first 3-line journal entry. Well, we bought equipment. And how much was the equipment? $1,000. How much did he make as a down payment? $300. So cash goes down. And what happened to accounts payable? That has to go up by $700. We bought something for $1,000. We paid $300 down. Let's take a look. Delivery equipment, $1,000. Cash went down $300, and accounts payable went up $700 because we owe these people $700. And look, our equation is still in balance. Got a few more of these, and then we'll be closing shop for the day, guys, okay? Thanks for hanging in there. Payment of insurance premium. He bought an insurance policy that's going to last 7 months, okay? He bought this policy, we'll pretend, in December of 2020. but the policy does not go into effect until January 1st. This is an insurance policy. It protects them if the business has a problem, there's some damage. So he bought the policy on December 31st, and sad to say, that evening, around 11 in the morning, the business had suffered a fire and there was damage. He's not insured. He's not insured until until December's over. So that means that until he starts using using the insurance, getting the benefit of it, it is an asset called prepaid insurance. So you have two prepaid assets up here: prepaid supplies we haven't used yet, and prepaid insurance that does not affect this month so far. Paid wages. Okay, well, we know what that expense is. That's going to be salaries expense, or in this case, they're calling it wages expense. Wages expense goes up, cash goes down. Whoa, that cash is getting low, huh? He paid $1,650, and the expense went up $1,650. So the equity went down by $1,650. And now here, he made a delivery for cash and on account. Before, we purchased something for cash on account. So he delivered $3,500 worth of pizzas. Customers paid him $900 in cash, and the balance was in accounts receivable. How much did he sell? $3,500. How much cash did he walk home with? $900. The balance is in accounts receivable. 3470. 3470. We're up to now. There's the 900 in cash. So two assets went up and revenues went up. So this he's got a profitable business going. Here is the withdrawal from cash. And this, I think, is going to be our last transaction leading up to the final part of the lecture. Okay. Withdrawal of cash from the business. Mitch took $3,000 out of the business for his own personal expenses. Okay. He's going on vacation with his family. So what happened here? He took cash out. Cash goes down, and this drawing account increases. So let's see how it plays out. Okay, 3,000 minus cash, right there. He took 3,000 out for his own personal use. Notice the capital account here, 5,000. That's in there as the default plus. So look at your accounting equation. Assets equals liabilities plus equity. And the equity started out at 5,000. And then it went up by 8. It went down by 2,750. And now it went down by 3,000. So you have an ending equity right now, if you will, of the 9,150. Okay. Now we're just going to go over financial statements briefly, and we'll get on with our week. Prepare and describe the purposes of a simple income statement, statement of owner's equity, and balance sheet. Okay. All the information we're going to use is right here, right here. What was our income? Well, income is simply sales or revenues minus expenses. Revenues minus expenses. Our revenues were 8,000. Our expenses were 2,750. So the difference, I guess, is 5,250 if I did that right in my head, okay? You have to prepare 3 statements every month. This is just 3 of others. Income statement, statement of equity, and the balance sheet. It's important to understand that these statements must be done in this order, which I'm going to demonstrate. You must start with the income statement because you must figure out the net income. And once you have the net income, that's how much is going to increase the equity of the company. And once you have the new equity, you can now finish what's called the balance sheet. Okay. When you're doing these statements, you always start with the name of the company and what the statement is. And then you're either going to say for the month ended or as of, and that's an important distinction we'll go over. You see all this slide here? Don't even look at that slide, to be honest with you. Income statement. Take a look at your first financial statement. You know, you're all Mitchell. You want to see if you made money. Well, the sales were 8,000 and the expenses were 2,750. What were those three expenses? Remember, we had the wages expense, we had the rent and the phone expense. You add them up, it's $2,750. So this guy made a profit of $5,250. Not too hard. Anybody have any questions or anything? Silence is golden. Okay, now that we've done the income statement, which must be done first, now we can do the equity statement. The equity statement. And where did we get all these numbers? Well, there was no business on June 1st, but he started off with $5,000 of his own money. Here's the income. You're going to add the income, which we just determined from the income statement. The income was $5,250, but we know he took $3,000 out, so that reduces his equity. So the net change was $2,250 and leaving us with $7,250. $7,250 is what this business is worth at the end of the month. So he grew this business from 5,000 to 7,200. He grew this business by over 40%. That's a pretty darn good business, huh? If he had put $5,000 in the bank for 1 month, he wouldn't have even gotten $1. The interest rates are so low, it's just unbelievable. Interest rates are about 1%, so that's $50 a year divided by, he would have got about $4. Instead, he got $2,250. Huh? It pays to take a risk. So now we know that the capital is $7,250. And let me just take you to the balance sheet. The balance sheet. This reports the firm's assets, liabilities, and owner's equity on a specific date. And I want to bring that to your attention. You notice what it says here at the top of the income statement. It says for the month ended June 30, right? For the month ended June 30. Because these numbers are cumulative. They get bigger and bigger every day. After the first day, your revenue was 100. Next day, it's another 100. Next day, it's 300 more. It grows. It's a video. The balance sheet is a photograph. It is a snapshot of a point in time. That's why you can't say for the month of June. You can't say month of June, something like that. You must say as of June 30th. You have to have a specific date there. Wow, we're in balance. Total assets equals total owner's equity and liabilities. The balance sheet, in other words, is a presentation, really, of the accounting equation. Where did we get these numbers? Remember the 470, the 3,100? We got them right from here. Our ending balance is 470, 3,100, 8,700. We had 9,150 in assets and 1,900 in liabilities. There's the 9,150. There are your liabilities. And we picked up the 7,250 from the income statement, and we're in balance. So somebody can come walking into this business and start asking all kinds of questions, huh? They'll say, okay, well, let's see what you have here. You have 1,050 in assets and you have 1,900 in liabilities. That looks pretty darn good. Input, processing, output. I'm not sure this ends up on the test, but this could be in your notes briefly. You know, you don't copy the whole thing down. You know, input, processing, output. And that's the end of our class. Could you guys hold on one more time, please? Just for oh. Hey, I've come back. I'm all charged up. And so is the computer. Ladies and gentlemen, any questions? What do you think, Jeremy? Oh, I'm sorry. Go ahead. Who wants to say something?
Oh, well, I mean, if Jeremy wants to talk first, that's fine.
Well, I was,
Well,
you go ahead. Who's ever talking?
all right.
Who's this?
Bastion.
Oh, Bastion, go ahead.
So to start off even recording, we have to know, right? I read into it a bit. We have to, if our chart of our accounts is empty, we have to start with that, right?
Absolutely correct.
So first we need to create a chart of accounts and then
Yep.
add categories before defining what each section is a liability or equity, right?
Absolutely. Setting up the chart of accounts, and we're going to be talking about that quite a bit.
Oh, okay.
Is yeah, you're gonna start a business, and you're gonna think to yourself, okay, I'm gonna use QuickBooks, okay? And you go into QuickBooks, and they'll have a bunch of defaults that you can choose, right? Or you can make up your own. So yeah, you certainly want to have cash as the first one, and then accounts receivable would be next. The chart of accounts, everybody, goes in order from assets, liabilities, equity, revenue, and expenses. And that's important to understand, and you will. Yeah. Does that answer your question, Vestian?
Yes, it does. Thank you.
Okay. Anybody else have a question?
I was just wondering if these are going to be uploaded for later reference, like if we can watch the lecture over again if we were to miss one.
Yes, yes. This lecture will be available in two places. It takes me a couple hours to get it over to Cornelia in a format. She puts it in Canvas. So all you have to do is go to the module for the chapter, and you'll see the link to see this video whenever you want. Okay.
Okay, awesome. Thank you so much.
It's also on my I roll my eyes when I say this, the Bob Smagula YouTube channel, which anybody can access. And I've been accumulating these for the last few years. So if you look at this video, and then when you can't see my face, that's distracting, you can always go and find other chapter 2 videos I did for this course in my YouTube channel. So you have two places, okay?
Thank you.
All right. What do you think, Christine? We're making progress here?
Yep. Sorry, I'm eating my lunch as I watch. Yeah, totally making progress. In fact, the last question I was going to ask, so that takes care of that.
Okay. Good, good.
Thank you.
Any comments, Jeremy? All right.
Nothing much so far. I've been liking it so far. Been
Yeah,
good.
so far, so good. And
Yep.
who else? Oh, Patty's here. Hi, Patty.
Yo,
Doing okay with this? You're not overwhelmed or anything yet?
nah, not yet.
No, we shouldn't be. Okay. Thank you for being here. And you know, I'm tutoring every evening. I had a couple of you guys here last night. I'm tutoring, as you know, from the schedule at 5 o'clock, Tuesday, Wednesday, Thursday, Friday, and noon on Saturday. And I go from 5 o'clock until whenever I have somebody. So sometimes I work from 5 to 6:30. If there's nobody here, I cut out. But if somebody needs help, that's fine too. I stay as long as needed. And we encourage you to come in for tutoring once in a while, even if it's just to hang around or ask a quick question, help with your homework, that type of thing. Okay, guys?
Okay.
All right.
Sounds good.
Bastian,
Thank-
do you motion to leave the meeting, Bastian?
Everyone, today's lecture is over, and please be on your way.
Okay, thanks very much, everybody. Bye-bye now.
Thank you.
All
Thank
right,
you
all
all
of you have a great
very
one.
much.